Hi, everybody. My name is Michael Reinking. I am the senior market strategist here at the New York Stock Exchange. I've been here for a couple years now, and I also head up the Mac desk, which is a part of a kind of it's a product that we offer to our listed companies, where I work with kind of management teams, when they have questions in and around trading, markets, or the general macro environment. I write our daily market commentary, which is on the NYSE.com, so you can always kind of check that out, and then I'll leave Jonathan to do kind of a brief intro of himself.
Yeah, great. So thanks very much for having us. Jonathan Dunlop, I run Disruptive Commerce Investment Banking at JP Morgan. Been an investment banker for 15 years, had previously worked at a small startup company that grew very quickly and ended up selling to a strategic in the space in which we were spending time. Focus on disruptive brands like yourselves that are growing really quickly, looking to go public. Have been fortunate to work with the New York Stock Exchange on a number of IPOs over the years of digitally native brands, online retailers, online marketplaces, and really happy to be here and have a conversation.
All right, great. So we are at the New York Stock Exchange. This is kind of the center of capitalism. So it would be a little bit remiss to not kind of talk about the historic year that we saw in kind of 2022, and then kind of the where we are from an economic perspective, coming out of the pandemic. So 2022 was historic. We saw a 20% drawdown, call it, for the S&P 500. We've seen those sorts of drawdowns before. What was really different this time around is that there was really nowhere for investors to hide, right? So this was the first time in history, where we saw both, the returns in the Treasury market and equity markets that were both down over 10% in a single calendar year. Now we've seen that kind of a handful of times in history, but this was the biggest drawdown that we've ever seen. It was kind of high teens drawdowns in both kind of asset classes. Now if you kind of rewind a little bit to think about where we were coming into 2022. We were coming out of the pandemic. We had quite a bit of fiscal and monetary policy pumped into the economy. Kind of household balance sheets were kind of very strong. We saw saving rates, and then so coming into 2022, there was this expectation that you were going to start to see some of that policy support taken out of the market. Now there was the economy was accelerating. It did seem like we were kind of going to have some sort of return to normal or some semblance of normal in our daily lives, but there were still plenty of imbalances within supply chains and other kind of areas of the economy. Now we did start to see inflation start to percolate kind of in late 2021, and that really accelerated to the upside in Q1 last year when we had the invasion of Ukraine, and that sent commodity prices sharply higher and really forced the kind of hand of central banks around the globe to begin tightening monetary policy much more aggressively than anybody had previously expected. So we saw kind of inflation hitting levels that we hadn't seen since the 1980s. By the end of the year, we had the Federal Reserve raise rates by over 4%. We have the upper end of the Fed funds target is now at 4.5%, up from basically zero to start the year. We had 7 consecutive rate hikes, including 4 75 basis point rate hikes, which is pretty unprecedented in terms of the speed in which they tightened policy. Now, at this point, inflation was kind of the central theme throughout all of last year. We are seeing some signs that inflation is starting to ease, right? That's especially, we've seen that on the good side of things, right? As supply chains are starting to improve. We've seen commodity prices moving lower, right? And so now kind of the question from here is, we all understand that, the tightening of monetary policy will ultimately make its way into the economy. And, the question from here is really kind of how deep and how prolonged that pullback is going to be, as that, and we're sort of at the tip of the spear right now in terms of starting to see those impacts to begin hitting the economy. Right, so throughout last year, the U.S. economy was actually really resilient. As we mentioned, part of that was due to kind of consumer, the strength of the consumer balance sheet, kind of corporate balance sheets, and relative to the rest of the globe, the U.S. economy had held up really well. We did see monetary policy start to slow down the housing market. Right, that the housing market is kind of ground to a halt at this point, and that does have kind of multiplier effects on the economy, but we are also now starting to see some signs that the consumer, may have kind of, hit a little bit of a breaking point. And this morning we had our second consecutive monthly declines in retail sales numbers. So with that, I think it's a good kind of point to kind of bring Jonathan into the conversation here. Jonathan, you work for JP Morgan. You guys clearly have kind of a unique perspective in terms of where things are in the economy. What is kind of the house view for 2023?
Yeah, so it's a really good question, and I would say that our crystal ball is very murky right now. And I think, frankly, it's across Wall Street where we have perspectives on things, but I would also say that we've changed our rate outlook 9 times last year, and I'm sure that will happen again. But as we think about where we are today, to Michael's point, we are actually starting to see some of the knock-on effects of higher interest rates filter into the economy. It's starting to impact credit card rates, consumer balances, where consumers are spending money. Our overall view is that the economy will have relatively slow growth in the first couple quarters, but there will be growth. And then we will enter into a recession, moderate recession in Q3, Q4, with really the tipping point being the drawdown of excess savings that Americans had built up over COVID. That sort of peaked out at $2.5, $3 billion. That is now down to $1.5 billion. Our sort of models show that the savings rate that's filtering through the economy would imply sort of that excess savings runs out this summer. The interesting thing is we think about the overall year, we think it's like 0.5 point of GDP growth, and that will not actually be consumer driven. Consumer spending, we think, will be up sort of 2%. But it is really that sort of knock-on effect of interest rates, impact on investments that corporations make, combined with consumers starting to slow spending really in the back half of the year. And so, we're all hopeful that there is an ability to thread the needle and that the Fed is going to find that balance between high enough interest rates that it cools off the economy enough to bring down inflation without putting a tremendous amount of people out of jobs. That has been the concern over the course of the fall, is that if consumer spending doesn't abate, if unemployment doesn't rise, that they'll have to keep hiking until they have significant sort of job losses and get people to just stop spending money because they don't have it. But like I said, our crystal ball is a little murky. Resolution to the Russia-Ukraine conflict would clearly be a tailwind to the economy and to the uncertainty that's out there. A view on when the Fed actually stops hiking would be helpful. Our view is January, there's another hike, and then February, and we sort of top out at 5%, and then they pause. If they keep going, that's going to have a bigger impact on where the sort of back half of the year ends up.
Right. Yeah, and I think that's, just to kind of touch on a couple points that you made there, right? The idea of the Fed, kind of pulling off a soft landing, right? We've never in history seen the Federal Reserve able to kind of move inflation lower by as much as they need to currently without a significant ramp in unemployment, right? So, there is this idea that, you could have immaculate disinflation, where you don't, necessarily have, see the impacts, in the employment markets, but that's, something that they haven't, necessarily ever pulled off, previously. So, if you think back to kind of 2020, 2021, I think one of the things that surprised people the most was kind of the amount of issuance and capital markets activity, coming out of the pandemic. With kind of the volatility that we've seen over the last year and the tighter monetary policy, we've seen capital markets activity really kind of grind to a halt. What is your kind of perspective as we look forward to kind of 2023?
So it's a little bit of the same as we saw in the back half of the year. If you take a step back and think about 2022, markets started falling apart in the spring. Private capital markets tend to lag public markets by 4 to 6 months. And we saw continued sort of rapid pace of activity in private capital markets through the first half of the year, but that very quickly over the summer dried up. There are certainly a tremendous amount of capital on the sidelines, whether it's private equity, growth equity, VCs, everyone's looking to deploy. There's just a little bit of a disconnect between investors, sellers, companies, and finding that middle ground has been very difficult over the last 6 months. We expect that that's probably going to continue for the next 6 months. If we think about what's been driving all this, there has been the class of 2021 IPOs within tech and consumer and sort of growth consumer retail. They haven't performed very well. And that's partially been a product of rising interest rates, because growth companies, when you have interest rates rising, it's just math around discounted cash flows. A lot of that value is in the future, and interest rates go up, and those valuations are going to come down much faster than the more traditional consumer staples like the P&Gs and the like. Part of it is a realization that there were a number of companies that went public that probably shouldn't be public companies. They didn't have the scale to really be able to have the organization to predict things on a quarterly basis. That's the unfortunate reality about being a public company, is you got to go report to your investors every quarter, and if you don't get those numbers right, particularly out of the gates, you get punished quite swiftly. And on top of that, we have a view from a lot of investors that they don't know where the economy is going. And particularly for consumer-related companies, particularly on the discretionary side, I think there's a little bit of a schmuck factor, to be honest, where people don't want to deploy a tremendous amount of capital into situations that might make them look bad, particularly with the uncertainty. So what we've seen is solutions around structure. Deals are still getting done. There is a tremendous amount of capital out there. Like I said, people want to do deals, investors want to do deals, companies that need funding are going out there, but to solve valuation disconnects, there's been a lot of structure that's being put in place. There's 2 times liquidation preference, when in 2020 and 2021, it was very clean deals. And so we're trying to navigate that with a lot of our clients. I think the reality is, a lot of people are sitting on the sidelines. If you don't need to raise capital today, it's probably not the right time to be proactively going out there. Certainly, I think there are defensive raises, and it's been 50, 60 weeks without a consumer retail IPO. And even if we think about the one tech IPO last year, it was Mobileye out of Intel, and a pretty well-known story. So there haven't really been tech IPOs, and we need that sort of activity to come back as well, because as we think about where investors want to deploy capital, they want to see an exit. And if they don't see an exit for an IPO exit, or they have a view that companies aren't going to be able to scale to the levels they need to scale to become a public company, that's also impacting interest.
Okay, so I do have a couple of follow-ups on that, but I guess we'll start with kind of scalability, right? And in your view, is like an e-commerce brand something that is scalable at this point?
I would say it really depends on the category, to be honest. It depends on what the business looks like. It depends on average order values in the categories in which companies are operating, whether you can run a profitable digital business and have gross margins and contribution margins that actually work. I think what we've seen is, apparel tends to actually be a pretty good category for online. If you look at the number of online public companies or digital companies, a lot of them are actually in apparel, because the AOVs work and the unit economics work, and even with returns, it's something that the sort of business model works. I think where we've seen more struggle, and remains an open question, is on the consumer side, can you scale a digital consumer business purely online? And you've seen sort of some of the early innovators like a Harry's or an Honest Company that got to 250, 300 million of sales, and quickly realized that to move beyond that scale, they needed to move into omnichannel. They needed to partner with the Walmarts and Targets of this world in order to sort of, counterintuitively, it's higher margin to be in that channel than to be in the DTC channel, particularly once you incorporate how much it costs to acquire customers. That's the other issue we've had last year, is that all the changes that Apple's made has really impacted the ability to acquire customers. I'm sure you all are living that every day. And so I think there remains a question around, can you scale digital consumer businesses to become a billion-dollar business? I think that's an open question from investors. At the same time, I think most companies have been pretty nimble about their go-to-market strategies and moving into omni-channel or moving into retail, if that's a category that makes sense. But it's an open debate right now. There is certainly a lot of negative sentiment around digital brands. I personally think that it's overdone, right? And I'm sure everyone in this room does too, because that's the world in which you operate. But that's the world we're living in, and so we're doing our best to sort of educate investors around where there are opportunities, where companies can be more focused. And a lot of companies are really heads down for this year, focusing on finding how do I take advantage of this turmoil and frankly this pause in activity to get my house in order and position myself for coming out of the cycle.
Okay, so It sounds like one of the issues that's kind of gumming up the pipeline right now is kind of this valuation disconnect between kind of buyers and sellers. So a little bit of a bid-ask situation. As people are, or as companies are, working through that process to, kind of ultimately, come out of this cycle, what do you think that investors are kind of specifically focusing on? What sort of metrics that are kind of important, and what are some of the actions that you think kind of small and medium-sized businesses can take at this point, kind of coming out of a difficult part of the economic cycle?
Yeah, absolutely. So if we take a step back and think about where we were 4 years ago, it was like growth at all costs. You can grow into your cost base, you can grow into scale, and as you scale, you will achieve benefits that allow you to become a profitable business. I think today investors are very much focused on, back to the earlier comment, what do your gross margins look like? What do your fully burdened contribution margins look like? And if you have a business model that works on that front, certainly investing in G&A, investing in marketing to build your brand makes a total amount of sense. What investors are not willing to do is underwrite people that are saying, I will get there on the gross margins, right? I will get there on contribution margins. I think the reality is proven out that as you scale, it doesn't get easier, it actually gets more difficult, right? There's a lot more complexity to the business. You actually have, more people come after you from a competitive standpoint. And so investors are very focused on the unit economics of businesses today. I wouldn't say that, some clients have come to us and say, so should we not grow and just focus on profitability? That's probably not the right answer either. There is a balance in there, but it fundamentally comes down to taking a hard look at your business and where does my business model work at this scale? And maybe there are some synergies or some benefits I can achieve as I scale, but where can I be really sort of extracting value, and where should I be focusing? And I think what are my sort of core competencies? And so that's where a lot of our clients are spending time this year, just sort of focusing on the business, focusing on whether their economics work, and then how to tell the story. A lot of people will go out and talk about LTV to CAC. That's great. CAC changes, as we all know, and those retention curves. Retention is probably more important even than sort of customer acquisition. Getting someone in the door, getting them to actually stay with your brand and be a loyal brand follower, that's what really drives profitability in the long run. And so that's where we're seeing a lot of people focus.
Got it. So I know you spent last week kind of at ICR, right? And there was as we mentioned, we had weak retail sales numbers this morning. I think markets last week, from a public equity market perspective, there was a little bit of a sigh of relief from markets that we didn't really see any big negative pre-announcements coming out of the ICR conference. What were some of the key themes or takeaways that you had from last week?
Yeah. So certainly on the pre-announcement side, I think that was beneficial to the narrative. Q4, I think people were expecting it to be a little bit weaker than what we've seen so far. We have yet to see the bulk of the public markets and consumer retail and technology report yet. And when those come out, we'll get a little bit more visibility. I think today there's a little bit of consternation as you think about consumer spending when you see Richemont's numbers and Burberry's numbers in the US that were expected to be incredibly strong, and luxury's been a very resilient category. They came in pretty weak today. And we'll see what the rest of the sort of luxury industry looks like, but that will create consternation around the health of the highest income customer, which has been viewed to be quite resilient. And I think a lot of premium and luxury brands have felt like they were more insulated than other parts of the economy. So there was certainly, so that's one aspect of ICR. The other piece is just back to the capital piece. Private equity guys saying, I'm more money to deploy than I've ever had. And where should I be focused? Where can I spend time? Another big focus is services, which everyone's I want to be in consumer services, and it would make it seem like no one's ever going to buy a product again, which is clearly not the case. But Amazon doesn't play in services, and so there's a little bit of a herd mentality of how do I get away from my Amazon risk, go into services. All that said, I think people are pretty excited about what this next stage of the economy and investing is going to look like. The disruption that's happening from a brand's perspective, that's real. There are a lot of brands that have not changed with the times. They don't know how to speak to today's customers. There are new brands that are taking those places, and it's just a little bit of a transition that we're going through right now as older brands fall by the wayside, new brands replace them. And so there is a lot of optimism around around where there are opportunities, but it's just going to take a little bit of time to rebalance the world and find that sort of close that bid-ask spread, as you said.
Got it. Okay. All right. Well, I think this is kind of a great time to kind of open up the floor to some questions from around the room.
Yes, that's perfect. Is there any? We'll take like maybe 2 questions, and then we'll keep things going. Yeah.
Not a question,
Boom.
I'll come get your card.
Mic drop. Right there. Take advantage. Any other thoughts or questions or asks? Yeah, right back here.
So one thing I always note is being ignored in all of this talk of growth, and something that a lot of these people in this room are going to experience, is the battle between packaged goods suppliers and retailers for margin. That's going to be the single biggest pressure I think most of us in this room are going to face, because everybody, because of the public markets, is looking for that increased margin over time, and that's where the battle is going to be. So I'm wondering what kind of impact that could have on your thinking.
No, it's a really good question, right? I mean, Walmart in particular is famous for its desire to just constantly drive margins, and it does feel like there's a battle between the two. Unfortunate reality is probably what COVID has taught us more than anything else is scale really matters, and these retailers are even more important to companies than they were before, and so that is a battle, right? And I think that's about managing the sort of competitive set of the retailers that you're working with, and frankly playing them off of each other a little bit. I think there are certain companies that have been quite effective at using exclusivities with some of the large retailers like Target and others to sort of drive brand awareness, drive profitable sales for both themselves and the retailer, and then using that exclusivity as a hammer with other retailers as they think about sort of expanding. But that is a key battleground, to your point.
Yeah, that's a great question. And guys, thanks again. Michael and Jonathan, thanks for being here. Thanks for hosting us today here at the Stock Exchange, and thanks for the session. That was awesome.
Thanks for having us.
Thanks, everybody.